When you own a family business and it's time to retire, the question is, how do you structure the buyout and will it work? We're going to dig into that today. When I start working with companies on the potential buyout of the senior owners of the company, it's kind of interesting that you've got to study whether or not the buyout's going to work. And a lot of people don't take the time to really think all that through. So one of the important things to do is to analyze the pre and the post-tax cost of the transaction. In addition to that, studying the cash flows and how does the buyout impact the cash flows of the company. And the cash flows can be impacted by a number of things. So I'm going to write on my little board here, and I think I'll pick the blue this time around. But one of the first things you've got to figure out is what the valuation is. And when I talk about the valuation, there's the valuation if you're going to sell to outsiders. And then there's the valuation that you would sell to insiders. If the insiders are non-family, guess what? The price might be a little bit higher than if you're selling to family. But the valuation dictates how the whole economics of the buyout come together. The second thing is the retirement income needs of the sellers. If the owners were used to getting $200,000 a year and they retire and they get a buyout that's paying them $150,000 a year, and at the end of 10 years it's gone, then in year 11 plus, they're going to see an elimination of income, and they better make sure they have other assets in their financial statement that are going to carry them because the cash flow they're getting from the company is pretty much gone. If the valuation's too high, you can really screw up the buyers. If they're sons and daughters that are in the business running and operating it, you can end up having installment payments that are way too high, right? If the price is too low and you start paying installment payments to the seller has to pay capital gain tax on the principal that they're getting from the buyout. They've got to pay income tax on the interest portion of the buyout. And they could get to a situation where they're out of money by year 11. So it's a balancing act. I'm just going to write that down. It's a balancing act between the valuation and the retirement need of the sellers. Okay, so what a lot of this comes down to is cash flow management. How do you manage the after-tax cash flow of the company so that you're able to retain the money that you need to be able to operate the business, to have the working capital, and at the same time, make sure you can afford to pay these installment payments to the shareholders. Now, you are able to get rid of their salary, so that helps a lot. But you still have to do the mathematics of what it looks like. And so that means that you got to build models that basically show you the before and the after, what things look like before you do the sale and what things look like after, and then run different variables. One of the things that we like to do with the sellers is to look at their personal financial statement and then help them put together a retirement budget and get an idea of what their investments look like and what kind of income that can come off of those investments in retirement, so we can get an idea how much the buyout needs to be able to keep them in the lifestyle that they want. but it takes some real work. And oftentimes before we even do the transaction, we study the need that the owners have for cash flow, so we get an idea what that benchmark needs to look like. Then we look at the cash flow management of the company and say, what's really left over after business expenses, after paying for the current executives and the executives that you have to hire to replace the owners that are selling? What does the net cash flow look like? How much of it do we need to retain and keep on the financial statement to provide stability in the company, and how much we can give up to provide for the buyout? So these two things have got to come together. And it's not something that you can just sketch out on a notebook pad. You got to build all this into a model so that you can forecast how this thing all plays out. All right, so let's say we're working with a shareholder that is selling. One of the things that the shareholder has to look at is what type of sale are they doing? If they're selling to the outsider and they're going to buy the whole company in one fell swoop, and that company is buying stock, you'll have a capital gain, which is the sale price minus your basis. And then you'll have a tax, and you'll pay that tax all in 1 year, and it's over with. If you sell the stock on an installment sale, like I said before, you'll pay ordinary income tax on the interest and capital gain tax on the principal that you're receiving. And that's if you sell the stock. Now, I'm not a tax accountant and I'm not an attorney, so I'm going to just really do this at a high level. If you sell assets as opposed to stock, there's some big challenges there. A buyer wants to buy assets because once they buy those assets, even though you've depreciated them, they can depreciate them again. So from a tax standpoint, that really helps the buyer. But when it comes to the seller, if you have accumulated depreciation on your financial statement, you have to recapture it all. And so the seller can get just killed by huge taxes if they sell the company that way. Now, a lot of times when Generation 2 are buying from Generation 1, they want to set up a new corporation. They want to buy assets and be able to depreciate them. A lot of times people do that too for liability protection. The new company doesn't have to pick up the liabilities of the company they just bought. So that's something that you have to kind of work out with the accountants and the attorneys to decide what's going to be the best strategy there. But all of this needs to be modeled into spreadsheets so you can kind of see the before and after of what this is going to look like. Now, let's say that we start working with the seller and we know what the valuation is. And the valuation is adequate to provide cash flow during the term of the loan. But once that loan payment is off, once it's done, they're going to have a big problem. What we try to do is to come up with a financial model for them that'll help them out. So let's say, for example, you got a good bag of money right now that it's investments, maybe it's 401k money, pension money, maybe it's investments at a brokerage account. And you know that for like 10 years, you're going to be getting income from the buyout. And frankly, you can live on that buyout money. But at the end of 10 years, it's gone. What we try to do is to guide the owners that are selling to develop an investment plan so that once these buyout payments stop, the investment accounts can carry on and provide the wealth that they need to survive. You'd be amazed at how many times we get into this. And the seller is used to getting dividends and salaries out of the business and their lifestyle. They've just gotten comfortable with it. If they sell the company, they're able to continue on with that lifestyle for 10 years. It's different income, but they've got it. But they have a huge cliff at year 11. What's really important is to model out what do you do with the money that you have today so that you can invest it sufficiently so that from year 11 plus, you're taken care of with the money that you've set aside. You got to figure out how much of it do you need to keep invested, how much of it can be spent. You obviously don't want to get into your 80s before you start spending money on stuff that's fun. But if you're 65 or so or 70 and you sell, you want to be able to use this money to play. But it gets back to what does your lifestyle look like? And let's say, for example, we get in a situation where the valuation just is not matching up with the income needs of the person that's selling. A lot of times we can extend the buyout. We can raise the price of the shares if it's family members that are buying out other family members. You can raise the price and you can extend the installment payments from 10 years to 15 years or something like that. It's a real balancing act to come up with the strategy that you know is going to meet the needs of the seller versus the cash flow requirements of the buyer. Now, if I'm a seller and I'm on the installment plan, and I know that my cash flow in retirement hinges on what the young management group is going to do with the company, that could give you a little bit of heartburn. And so one of the things that we really try to do is, if we've got a CEO here and we've got a management group that includes the CFO, COO, head of HR, head of sales, what have you, one of the things that we like to do before we even do the transaction is to see whether or not we have the right people in the right seats to run and operate the business. If we think we do, we want to put them through a business boot camp to tune them up on all facets of running and operating the business. So just because the family members, it's like, so what? We want them to go through a boot camp because we want them to be on their A game and we want them to be accountable. Because if the company goes down when installment payments are being made to parents or owners for 10 years, let's say they run it in the ground at year 5, the seller's never going to get their full check, their full amount of money. So we've got to make sure that this group is competent and that they have the ability to go through business boot camps to get better and better and better at what they're doing. That's really important. All right, the last thing I want to talk to you about is doing catastrophe planning in the middle of all this. Let's say you come up with a great idea for the valuation. You come up with a great plan for the installments. You have a great team that's fit all the different pieces of the org chart. We've got everybody competent. But there's one or two really key people that are in charge of running the operation. Maybe they're co-shareholders, which we often see. I mean, rarely in a lot of these deals today do we see just one person buying out everybody. There's usually multiple shareholders. But you can have some key people that are essential to running and operating the company. And if they lost these two people, it would put everything else in jeopardy, including the installment payments to the sellers. What we recommend doing is getting life insurance on the buyers. So if the buyers are making installment payment to the sellers, we want to make sure that if one of these guys goes down, that there is life insurance in place to complete the installments, to pay off the debt that is owed. Because if one of these key people die and they're not around to help run and operate the company, there's a real risk that these people aren't ever going to get paid. In addition to that, you need to have buy-sell agreements. The new owners, they need to have a buy-sell agreement between the two of them so that if one of them dies, their families are paid what the value of their stock is, and the surviving owner then can own 100% of the shares. But think about the complication. If you owe debt to the sellers at the same time one of the key shareholders dies, think about the financial responsibility that's left on the survivor. He's got to pay out the people that they bought the business from, and he has to pay out the family members, the wife and the children of the shareholder that just died. So at the end of it all, it's really important to do catastrophe planning to make sure that in the event a catastrophe occurs, that everything works out financially. And life insurance is the only way to do that. If you need any help with this, just let me know. We have all the models and all the spreadsheeting that we can do to figure out all the financial impacts of a sale and a succession plan. Everything from what happens with the shareholders, everything that what happens with the buyers and the corporation in modeling the after-tax cost and the cash flows required to support each side of the transaction. We have the team that can go in and help with the org chart and put your people through a good business boot camp. And we've got software that we call it War Room Technologies, which it's a command and control center for business that will help the owners get in real time the information they need to make smart business decisions. So we can provide that, and we can also provide you the planning on the catastrophe plan to make sure that the insurance is built the right way. So that's just a little, what do you call this? A chalk talk? Is that what they call it in athletics? A chalk talk? The coach brings you into the game room and wants to teach you. So this is my best way of doing a chalk talk on buying out shareholders, doing succession planning, and making sure you got a company that runs real well when it's all said and done, and the sellers will be fine in retirement.